In October 1907, America's financial system began collapsing. Banks were running out of cash. The stock market was falling. Terrified depositors formed lines outside financial institutions, demanding their money before it disappeared. But America had no central bank to stop the panic. The government could not simply order someone to rescue the system. So one private banker summoned the most powerful financiers in America to his library and pushed them to provide the money needed to prevent a complete collapse. His name was J.P. Morgan. That night exposed a terrifying weakness. The survival of the American economy depended on one unelected man. 6 years later, the Federal Reserve was created. But to understand how the Federal Reserve became the most powerful financial institution in America, we have to return to the gamble that started the panic. In 1907, two speculators attempted to corner the market in United Copper stock. Their plan appeared simple: buy enough shares to control the supply, force short sellers to purchase from them, and drive the price upward. Instead, the scheme failed spectacularly. United Copper shares collapsed. The men behind the operation suffered enormous losses, and rumors spread that banks connected to them could also be in trouble. Depositors did not wait for proof. They wanted cash. The fear soon reached Knickerbocker Trust Company, one of the largest trust companies in New York. When Knickerbocker's leadership became connected to the failed copper scheme, confidence vanished. Crowds gathered outside its doors, demanding their deposits. Knickerbocker could not satisfy everyone. It suspended operations. That closure sent a message across the country. If an institution this large could fall, perhaps no bank was safe. The panic spread. People began removing money from trust companies. Banks became afraid to lend to one another. Businesses struggled to obtain credit. Stock prices fell as investors sold anything they could turn into cash. America was discovering that a financial system does not collapse only when money disappears. It can collapse when trust disappears. And there was no Federal Reserve waiting to provide emergency funds. That left J.P. Morgan. Morgan was already one of the most powerful financiers in the world. He had helped reorganize railroads, created enormous corporations, and maintained relationships with the country's wealthiest bankers. Now, at 70 years old, he became America's unofficial central banker. Morgan and his associates examined the financial records of threatened institutions. They decided which firms could survive and which could not. He organized pools of money from banks, trust companies, and wealthy financiers. The United States Treasury also deposited government funds into national banks to increase available cash. Morgan gathered bankers inside his private library and pressured them to support institutions that were still financially sound. The rescue eventually slowed the panic, but the damage was severe. Industrial production fell sharply, businesses failed, workers lost their jobs, and the economic contraction that followed was surpassed in severity only by the Great Depression. J.P. Morgan was praised for helping save the financial system, but Washington saw something deeply dangerous. What would happen during the next panic if Morgan were no longer alive? What if the next powerful banker refused to help? And should one private citizen possess the authority to decide which institutions survived and which were sacrificed? The panic of 1907 made one conclusion impossible to ignore. America needed a permanent lender of last resort. In 1908, Congress created the National Monetary Commission to study banking systems in the United States and Europe. Its chairman was Senator Nelson Aldrich. 2 years later, Aldrich and 5 other men secretly traveled to Jekyll Island, Georgia. The group included banking and financial experts such as Paul Warburg, Frank Vanderlip, and Henry Davison, a senior partner at J.P. Morgan's firm. They told people they were leaving for a duck hunting trip. During the journey, they reportedly used only their first names to prevent railroad employees from identifying them. Behind the closed doors of an exclusive private club, the 6 men spent more than a week designing a new banking system. Their proposal called for an institution capable of holding bank reserves, issuing flexible currency, moving money between regions, and supplying emergency credit during financial panics. The original Aldrich plan was rejected. Many Americans feared it would give Wall Street too much control over the nation's money. But the central idea survived. President Woodrow Wilson supported a compromise that divided authority between Washington and regional reserve banks. On December 23, 1913, Wilson signed the Federal Reserve Act. The new system included a government board in Washington and 12 regional Federal Reserve banks. It had been deliberately designed as a system, not one ordinary bank. Its original mission was to provide a safer, more flexible monetary and banking structure, but its influence grew far beyond emergency lending. Today, the Federal Reserve influences interest rates and credit conditions. It supervises major financial institutions, supports the payment system, serves as the government's bank, and acts during financial emergencies. Its decisions can affect mortgage rates, credit cards, business loans, employment, inflation, stock prices, and the value of the dollar. The institution created because one private banker possessed too much power, eventually gained powers greater than Morgan could have imagined. That does not mean the Federal Reserve controls everything. It cannot command businesses to invest or force consumers to spend. But it controls one of the most important forces inside any modern economy: the price and availability of money. The history of the Federal Reserve contains a powerful lesson. Institutions are often created during moments of fear, when an old system fails and the public demands protection. But protection always comes with power. The Panic of 1907 forced America to ask who should rescue the financial system when everyone else is afraid. The answer became the Federal Reserve. More than a century later, we are still debating how much power that answer should possess. If you want to understand who controls an economy, do not look only at who owns the money. Look at who controls credit when the panic begins. Subscribe to Outlaw Wisdom for more financial history and the lessons traditional education left behind. They never taught you this. We ride until they do.